By the way, the reason why these mortgages are now gone is because fixed mortgage rates dropped slightly at the beginning of February, only to see them jump back up as US inflation numbers came in higher than expected and Canadian jobs numbers shot through the roof. And in today's video, I'm going to give you all the rates, but I'm also going to show you things like how unexpected inflation data, jobs data, and the bond market affect fixed rate mortgages and why they don't necessarily move in unison with the Bank of Canada. But before we get into it, my name is Nolan Mathias, and if you want to thrive financially, this is the place for you. So go ahead, click that subscribe button and hit that like button so more people like you can see this video. And don't forget, you can still get my book, Mortgage Secrets, for free. Go to mortgagesecrets.ca. All you have to do is pay the shipping and handling. Okay, so after signs that fixed rates were about to go down in early February, US inflation data surprised on the upside, as did the Canadian jobs numbers, and that has led to fixed rates jumping up slightly in the middle of February. So this isn't the normal February mortgage update that we do at the beginning of the month. This is an update to that because interest rates did, like I say, go up. And I'll show you at the end, something happened to that special 3-year rate that we had that you aren't going to want to miss. So let's jump into the news here and show you exactly what happened in the economy that caused fixed rates to go up. So first and foremost, there was news out of the US that US inflation climbed by 0.5% in January. This is the most it had climbed in 3 months. And as a result, that had bond traders adjusting their bets with respect to interest rates. So how this works is that bonds over the long term, so 3, 5, 10 years, are priced based on what the expectations that interest rates are going to do over those time horizons. And with higher inflation data, the expectation became that interest rates are probably going to stay higher for longer. So therefore, those bond market yields went up. Now, I'll get to why that's important for fixed rate mortgages in a minute. But I also wanted to show you the Canadian job numbers because this also added to upward pressure on bond yields and subsequently on fixed mortgage rates. Now, it was expected that in January, 15,000 jobs would be added to the economy. It turned out that 150,000 were added. So this is 10x what was expected. And most of these jobs were full-time jobs. So expect with this Bank of Canada pause that is happening, that the pause might be shorter than previously expected, especially with these continued high job numbers. Now, as a result of the higher than expected inflation in the US and the better than expected job numbers in Canada, we saw bond market yields climb quite substantially. And by the way, I suspect in our March update on March 1st that interest rates are going to be even higher than they are in this video. But if you go and you take a look here, you can see that on January 1st, the 5-year bond yield was 2.94%. Now, as of today, bond yields are at 4.54%. So in other words, bond yields have increased by 0.5% in the last 18 days. Now, bond yields are used to price mortgages in Canada, and typically there's about 120 to 150 basis point spread between the fixed rates that Canadians will pay and the 5-year Canadian bond yield. Now, over the last 6 to 8 months, that spread has gotten bigger, so you can expect that you'll probably see fixed rates go up over the next couple of weeks. And why is the Canada 5-year bond yield tied to the 5-year fixed rate? Well, because the bond yield represents the opportunity cost for the banks. They can choose to either invest in the very, very safe Canada bond, or they can choose to lend it in safe mortgages, not necessarily as safe as the Canada bonds, but they have to add a premium for the added risk that comes along with lending the money to Canadians for mortgages over lending it to the Canadian government. And you'll see a little bit later on here that mortgage pricing is very much based on the risk of the mortgages. The higher the risk, the higher the prices. And just as an added aside, if you're watching mortgage rates and you want to know what's going to happen with fixed rates prior to it happening, if you watch these Canada bond yields and you see jumps or you see them come down, that's usually indicative of what's about to happen with fixed rate mortgages. So if you watch the Canadian 5-year government bond, you'll usually have a pretty good indication of what's going to happen with the fixed rate mortgages with a 2 or 3 day lead up prior to the changes actually happening. So how do these changes to the bond yield actually affect interest rates? Well, let's start first and foremost with the 5-year fixed full feature mortgage. Now, keep in mind, 5-year fixed full feature mortgages, these are the ones that have the lower payout penalties. They have all the prepayment privileges. These are the best of the best mortgages for the A-plus clients. These are typically not your big bank mortgages. These are the mortgages that come from lenders that specialize in mortgages. And the big advantage that they have is they can't skate off their marketing budgets and their reputations, so they actually have better products, and as a result, they typically have significantly lower penalties, usually 3 to 5 times lower than the big banks, which is important because if interest rates do go down at some point in the future, you want to be able to make sure that you can pay out your penalty and get a lower interest rate. Don't be one of those people like the people in the pandemic who had a big bank 5-year fixed mortgage thinking that, hey, we got the best mortgage, big discount, and then all of a sudden couldn't get a lower rate because the banks had put in these super big penalties that would not allow them to be able to move their mortgage and get a better rate. Yes, some of them were able to blend and extend, but they still left tens of thousands of dollars on the table. So first and foremost, the insured mortgages are up to 4.89. This got as low as 4.79 mid-month. And then as we start to get to the more risky mortgages, so 20% down being the point where the lenders no longer have insurance and therefore have the highest exposure, interest rates are at 5.19%. Then once you get to 25% down, they come to 5.09%. At 30% down, you get to 4.99%. At 35% down, you start to see the interest rates coming back to the insured levels, and that is primarily because the risk level associated with putting 35% down is largely considered to be about the same as a mortgage that has insurance on it. So in other words, the banks think it is highly unlikely that somebody will not pay their mortgage when it comes to a 35% down payment, or that they'll be able to sell the property and get back the money that they are owed. Now, if you're looking to buy a property that's priced over $1 million, if you're looking to refinance, or you're looking to extend to a 30-year amortization, these are what are called uninsurable mortgages. So in other words, the lenders can't get back insurance, because when you get to the 20 to 35% down range, the lenders are still putting back insurance on these mortgages, assuming that the properties are valued under $1 million. And this allows the lenders to offer lower pricing because they have that insurance. So if you're getting an uninsurable mortgage, you're looking at paying about 5.39%. Now, take a look at this chart. Basically, you see a lot of red on here and not a lot of green. Every single one of these rates went up at the end of the week this week. And I suspect when the March interest rate update comes along that you're going to see all of these rates even higher. So make sure that you subscribe and you hit the notification bell so you can get that video as soon as it comes out on March 1st. Now, moving into variable rate mortgages, not a lot has changed here, so I'm going to go through them pretty quickly. Insured mortgages are priced at prime minus 0.9, or in other words, 5.8%. 20% down, you're looking at prime minus 0.55%, of course, prime being 6.7%. That's after the most recent Bank of Canada increase. And then at 25% down, you're looking at a similar interest rate. Obviously, they're pricing in a lot more risk for the variable rate mortgages here. At 30% down, you're looking at prime minus 0.75. And at greater than 35% down, you're looking at prime minus 0.9. And of course, those uninsurable mortgages, these actually got better at the beginning of February. You're looking at prime minus 0.4. Now, moving on to discount mortgages. So what are discount mortgages? These are the ones that come with a catch. Just like everything else in life, you get what you pay for, and when you get an ultra low interest rate, you're going to have some features stripped away or some restrictions on what you can do in the future, which is really important to understand, especially considering that there is a likelihood, maybe not this year, but next year or the following year, that we could see interest rates come down, and the restrictions in these mortgages will prevent you from being able to get a lower interest rate, just like the big bank 5-year fix prevents you from being able to do that. Now, if you want more details on this, check out the Mortgage Secrets book. It's all in there. It's way more information than I can cover in this video, but hey, you can get all the information for free at mortgagesecrets.ca. So 5-year fixed discount mortgages, these are up from the beginning of the month at 4.64%. At 20% down, you're looking at 4.94%, 25% down, 4.84%, 30% down, 4.74%, and greater than 35% down, you're looking at 4.64. Now, they've also pretty much put an unapplicable for uninsured refinance over $1 million. So this is where if you want a 5-year fixed mortgage and you're buying over $1 million, or you're looking to do any of these things, that you're getting a full featured mortgage anyways. Moving into the discounted variable rate mortgages, 5-year variable discount mortgage insured is prime minus 1.15. Now, again, the big problem here is that you're stuck with these lenders once you're with them. So if you decide you want to lock into a fixed, or you decide you want to make some changes, you've lost all of your negotiating power because you can't leave the lender even if you pay the penalty. And that creates a pretty significant issue for you, especially in times where interest rates start to go down, which in a 5-year time horizon, which is how long you're getting the mortgage for, it is highly likely at some point that you're going to find a scenario where you're going to want to make some changes. So I typically don't recommend these mortgages, but I show you the information because I want to be transparent and I want you to have it anyways. At 20% down, prime minus 0.8. At 25% down, again, prime minus 0.8. At 30% down, prime minus 1. And at 35%, prime minus 1.15%. And then for uninsurable refinances over $1 million, 30-year amortizations, prime minus 0.2. Now, I mentioned the 3-year mortgage and the changes that you wouldn't want to miss. Well, you probably do want to miss this because unfortunately, these mortgages are now no longer available. There are 3-year mortgages available, but they're priced around 5.24 to 5.34%. So they aren't making the same sense that they made previously, but we'll watch for changes to this in the near future here as other rate specials come to the market. And by the way, the reason why these mortgages are now gone is because the market now expects that 3-year mortgages will be higher for longer. And as a result, they can't price these as low as they thought they could because the 3-year bond yields went up substantially. Now, if you want to know more about interest rates and future projections, make sure you check out this video right here. a serious warning about interest rates because a lot of the news about interest rates going down at the end of 2023 and into 2024 is probably not accurate. So make sure you check that one out there.